Welcome, Dave. How are you?
I'm doing good, Alpesh. Thanks for having me on your podcast.
Oh, thank you for taking time out of your really busy schedule.
I've got a lot going on these days, but no, I like to see entrepreneurs and investors like yourself take action. So I usually try to make some time and support you guys.
Appreciate that, Dave. So yeah, Dave, as we have been talking about it, that I started this Wealth Matters podcast, and I've been interviewing a lot of them, syndicators as well as entrepreneurs or business owners, so that I can teach my listeners on how to build wealth, how to build actually generational wealth. The idea is, and should not be relying on one source of income. So you want to have second, third, fourth, fifth sources of income as well. And I've invested with you as well when I was starting. So I thought you'll be, a really perfect guest for this podcast. So looking forward to chatting with you for next 30 minutes or so.
No, I'm looking forward to it as well. And it's been a pleasure getting to know you and so your passion and your vision for the future and going forward, educating investors is a big part of my passion and my vision. So I think we're pretty well aligned. So I'm looking forward to it.
Thank you. So, Dev, tell us about yourself. Where are you located and what do you do?
So, with the exception of only about 2 or 3 months at a time, I've lived in Lancaster County, Pennsylvania, all of my life.
Okay.
And we do try to get away in the wintertime sometimes.
Of course.
But no, I'm a Lancaster County, Pennsylvania native. And
Wow.
so I grew up here. I was fortunate. My dad had a very successful business. I grew up in the
Oh,
family business. And
nice.
when I got into, my late teens, I started getting a little restless. I didn't know if I could, get out in the real world and make it on my own. And that was one of the primary drivers for me to start my own business and kind of venture out on my own. And
Nice.
so I started a sales and marketing company. I was heavily involved in our manufacturing company. We build modular buildings. But I saw my dad invest his extra cash into real estate, and I saw him self-manage some of his single-family homes, and I just, growing up, I was like, you know what, there's got to be a better way. I,
Right.
I'm not going to be a real estate investor. So I started investing in businesses and got myself in a position where those businesses started on really well, started
Nice.
making a lot of money, got myself in a position where I was paying $500,000 a year in tax. And
Oh, wow.
I was having a lot of fun, and it didn't feel like work because it was so much fun. I was making all kinds of money, but I was expending quite a bit of energy. And when it came down to the fact that I had to give half of my money back to the government, it wasn't so much fun anymore. So I went down this
Yeah.
path, and people usually ask me, "Well, how did you get involved in real estate? How did you get started?" And I tell them, "Well, it was I had no choice. I was chased into real estate because of my tax problem."
Yeah, real estate gives you depreciation, right? A lot of write-offs.
Yeah, and as I was studying, I was desperate. I wanted to get out from under this tax burden, and I was desperate. I was willing to do anything. And when I realized that real estate was a not only a good cash flow and a wealth building vehicle, but it was also a tax protection vehicle. That's what really got me interested, and
That's true.
that's what got me into the multifamily apartment space.
Nice. Yeah, that is interesting. So, you got started with multifamily, and how did you move into like syndication space or raising money?
Yeah, good question. I really didn't get into the space thinking that I was going to be a syndicator. I got into it because I had a problem, and it was sort of this natural progression that um, I was in the deal flow. I had a great broker, the number one broker in the city of Memphis, where I was doing a lot of business, and so I got in a position where I had bought a couple hundred units for myself, and I ran out of my own money,
Of
and
course.
so I was so I had a decision to make. I could move slower, but when I moved slower, I had to, I was at risk of getting that first call from the number one broker in the city. He's
Right.
bringing me these good deals, and back then, 2011, 12, 13, I mean, there was deals
You
everywhere, and
have to, yeah, you have to take an action at that time.
yeah, a lot of low hanging fruit,
Yeah.
and so it was about that time that I was invited to sit on the board of a local startup bank, and in the conversations that I heard around the table, a lot of these guys who were well able to write 7-figure checks, they were making comments like, well, I don't know if I should invest in the bank now, or it could be 5 to 7 years till we see any kind of return, but it's to probably be better than putting our money in a CD,
Oh
which at
no.
the time was, it was paying less than it was like a 0.5%.
Yeah.
So that's kind of when the light came on for me, and I was like, wow, this is, there's an opportunity here. We're making double
Right.
digit returns in our multifamily deals, and these guys are making a half a
Talking about
percent.
CD. Yes.
Yeah. So at the time, I wasn't very familiar with syndication, but I knew there was an opportunity here, and that's it,
Wow.
it just kind of unfolded. I didn't start out thinking I was going to be a syndicator, but it just kind of, the opportunity presented itself, and I jumped at it.
Right. That's awesome. So, I also, invested with you in ATM space as well. So I want to take this podcast and discuss about ATMs actually. So can you tell us more about ATMs and why ATMs?
Yeah, you should have got an email from us on Friday saying that we distributed your cash in your
Yes,
account.
I did. I got the money in the account too.
Yeah, well, see, I get copied on all of those emails, so I got like 200 of those emails on
Oh, nice.
Friday. So it was I get quite a lot of emails on the 25th of the month.
That's
But
true.
no, there's normally in the ATM space, you'll have sort of two different players. You'll have the mom and pop investor who will have 50 to 75 ATM machines within a 50-mile radius, and he'll service those machines himself. And
Okay.
it's just a small operation,
Right.
not too high, too high volume foot traffic through those locations. But he's the guy that will, service the machines. He'll place the cash.
Right.
He'll do everything himself. Then you have the institutional players like Cardtronics and some of those
Hmm.
big companies that are, billion-dollar plus
Right.
companies, and that's sort of been your two kind of players. I don't know of another company that does what we do. We're a small company. We got a really good team, but we're small. I mean, even though we've got all but $100 million worth of ATMs in the street, we're still considered small compared to the big institutional players. But we're the only company that I know of that deals in this space at this size. We're small enough to where we can, deal with individual investors. We're not a public company, but at the same time, we're big enough to where we're we're going out and bidding, and we're winning these bids. We're going out and bidding on portfolios of ATMs, and we're
Oh,
winning. And so what we do is when we go out and place a large portfolio of ATMs, we're not saturating the market. We're placing brand new ATMs in a location where there's been an ATM before. So we're
oh.
unseating somebody.
So it's
So,
basically existing locations
oh
where
yeah,
it's
and
already.
and and that's important because you're taking a lot of risk off the table because you're not guessing. You're not
Right.
guessing if this is
Right.
going to be a good location. You're going in and you can see a couple years worth of history, and
Yeah.
you know exactly how much transaction volume
Right.
is in each one of those
Yeah.
locations.
So
So
basically, you are able to see the P&L kind of deal,
oh
right?
yeah,
So you are
oh
not
yeah,
reinventing the wheel. You are not doing the market research. That has
yeah,
already been done pretty
and
much.
just like you would go and ask for a T12
Right.
on an apartment building, you get that same kind of data
Oh, okay. Yeah.
on an ATM. You can see exactly how much volume that
Yeah.
ATM location
Makes
has
sense.
done. So then we go out and we'll buy this portfolio. We go out in the market, and there's ATM brokers and all
Oh,
that,
okay.
just like there is
Multifamily, huh?
multifamily brokers, very similar. I mean,
Interesting.
obviously it's a much more nichey,
Yeah, it's a niche market space.
and not very many people know about it, but it happens. They're
Okay.
out there. So then our last portfolio, which happened right at the end of the year, was I think it was $10.4 million.
Oh,
and
wow.
and so what I'll do then is we'll break that down into $104,000 units, and we'll take it out to an investor who can invest 104,000. Needs to be an accredited investor,
Okay.
and and your unit will have 7 machines in it. Okay, so
Wow.
then our management company says, all right, your unit will get you 3,373 transactions per month,
Okay.
and your portion of that surcharge revenue, typically it's $2.75 to $3, something like that. Your portion of that surcharge revenue is 63 cents.
Okay.
And so what happens there is we'll then sort of put a preferred return on that. We'll say, look, if you don't make your 3,373 transactions per month, we'll chip in our portion of the revenue. We'll chip in our portion of the surcharge revenue. And then if you exceed 3,373 transactions, that's where we make some money, and we keep the upside. So it makes it,
Okay.
as you know, your amount hasn't changed from the time you signed on until today. Your amount coming into your account every month is exactly the same. And that's why we're taking the volatility out of that market and just making it to where you can really depend on consistent cash flow.
Right. Okay. That makes sense. Yeah, and when I was talking to you, I had the same questions, where are you buying these ATMs? What kind of market research? But if you're buying it in an existing location with a P&L and T12, then at least you know that this thing is working.
Oh yeah, we know exactly what we're getting into, and that's part of our due diligence when we go out and bid on these
Right.
portfolios.
Okay. So I was even talking to some other investors, and the same question I asked you before, they also said the same thing. Aren't ATMs dying? Aren't people doing most of the things online without cash? So what have you seen still?
That's a great question, and you would think that that would be the case. With all the new technologies, Apple Pay, Google Wallet, cryptocurrency, credit cards, you would
Right.
you would think that that would be the case. But unlike what everybody believes, the opposite is true. So, and I can give you a couple reasons why I think that's true. I mean, number one, the population is growing.
Mm-hmm.
Number
Of
two,
course.
number two, the demographics of folks that use ATM machines, they're the fastest growing group in the United States.
Really?
It's the lower income. It's the lower
That's
income
true.
folks. These guys are using ATMs as their bank. And I can tell you, as a rule, somebody who invests in ATM machines typically doesn't use ATM machines, and vice versa. Somebody that a
Right.
heavy user of ATM machines will not have enough of money to invest in ATM
Yeah.
machines.
It's similar as you can tell someone who invests in multifamily doesn't live in an apartment.
Yeah, right, right. Yeah. So I mean, and to your point, I had an investor say to me one time, and this was an investor who invested with me a lot over the years.
Okay.
He's invested in pretty much everything I do. He said to me early on, he was like, well, why would I invest in ATM machines? I don't ever use ATM machines.
Right.
And I said to him, well, why would you invest with me in C-class multifamily? You would never live in a C-class multifamily. So it's the same thing. You got to know, it's important to know who your
Target
end
audience.
user is, and understand who those people are. And no, it people who use ATMs do not invest in ATMs, and vice versa.
That is interesting. Yeah, and I think it makes sense, right? As we discussed. And same way, multifamily or mobile home park, etc. You don't live in a mobile home park,
Exactly.
right?
It's a wealth building vehicle. That's it.
Yeah.
And not only, I mean, as you know, not only do you invest in ATMs just for the cash flow, I mean, this is a great tax protection vehicle.
That's
Uh,
exactly what it was for me, right?
uh,
The
uh,
depreciation.
Sure, and 100% of this investment can be tax deductible, can be written off and used as a tax deduction, and that's a big part of this investment. A lot of your cash flow is tax free.
Yeah, that's the best part about this ATM investment. So that you brought up the cash free and tax protection. Can you elaborate on that? How the depreciation works and why there is a tax free income?
Yeah. So what happens when somebody invests in the ATMs? They get to write off. Let's say your $104,000 investment for a unit, you get to write off that full $104,000 over 5 years.
Oh, okay.
So five
Nice.
years, 5 years. That's $20,800 per year. Well,
Mm-hmm.
your cash flow is $25,500 per year. So really, when you take the cash flow and you deduct the $20,500 per year, you got the 25.5. You deduct the 20,500. So
2,800.
you're really only paying tax on
Like
5 grand.
about, yeah, 4 grand
Yeah,
actually less
4 or
than.
5 grand. So you got 70 to 80% of your cash flow is tax free.
Ah, that's interesting, and that's why I did it.
Yeah. No, I mean that's why I do it. I myself I invested in 5 units right here at the end of the year, and it was simply at the end of the year you got a choice to make. You got to either pay the tax or you got to invest in something
Ah,
that gives you depreciation. And for me, that's always an easy decision. I'd rather buy an asset that gives me depreciation that also gives me the tax benefit. I mean, the cash flow, because
cash flow.
not only not only do you get the special tax treatment, then you get the deductions, but this is I mean, as you know, this is a good cash flow vehicle. Uh,
Right.
so you're cash flowing in the double digits, plus you get all the tax benefits, and that's to me is a great deal.
And the income is considered as active income or passive income?
It's considered passive income,
Okay.
so you can use other passive losses to offset the rest of that income. Like I mentioned, the cash flow is so strong in ATMs that it doesn't cover quite all of your
Right.
it doesn't cover quite all of your income. Like your depreciation doesn't wipe out all of your income. But what you could do is you could also have, let's say extra depreciation from a multifamily deal or extra
Exactly.
from another asset that'll wipe out the rest of that cash flow so you don't get taxed on it.
That's exactly where I was going with that question. That I usually have passive losses from my real estate
Oh
investments,
yeah.
right? So this is a good vehicle for real estate investors, especially because I don't have to carry those passive losses year over year. I can just use this passive income from ATM to write off all the passive losses.
Yeah, and it's really a balancing act. I mean, it's when you got a clear picture of what's going on in your portfolio and your position coming into the fourth quarter, and you got to make some moves in the business world and the investing world to keep your tax situation under control. I
Right.
mean, that's powerful because I mean, and just so that your listeners understand, you're really taking paper losses
Right.
while at the same time sticking real cash in your pocket. So
Yep.
the losses aren't real. They're phantom losses. They're paper losses, but the cash is real.
Yep.
So
Yep.
you never want to get of the mindset that you believe that in order to pay less tax you got to pay less money. No,
That's not true.
you want to make more money and pay less tax.
Exactly. And
And that's totally
pay the legal taxes, right?
yeah,
With
yeah.
all the, legal write-offs available.
And really, you're only doing what the government wants you to do.
Right.
There 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 are specific tax codes that you are following when you're buying a specific kind of asset that gives you the deductions it does specifically because the government wants you to invest in those things. I always say, look, if you're paying a lot of tax, that's the government, that's a fine. That's the government's fine to you because you're not doing what the government wants you to do.
Exactly. You're speaking Tom Wheelwright's language, because I took his video course, and let me remind the listeners, he's the author of Tax Free Wealth, the best book on taxes out there. I read it, and he's also the CPA of Robert Kiyosaki, and I know even Dave uses his services as well.
I do, and it was from getting around those kind of guys that got me to the position where I really understood the tax law and where I started using it to my advantage. And he is back a couple years ago, a number of years ago, he's the one that really shook me up to the point where I knew that it was in my control. It was up to me. Whatever tax I was going to have to pay, it was up to me to change that. He said to me, if you want to change your tax, you got to change your facts. Exactly. And so at that moment, I knew that the reason I was getting taxed the way I was because of the way I was doing business or the way I was investing. I was involved in short-term capital gains, flipping some houses. I was a private money lender. I was doing all kinds of things like that, and it was all fun until the IRS showed up. So it's really not, it's really about how you invest, how you do business, and it's in your control.
Right. So let's go back to ATM. When you said they're depreciated, right? So what happens? For how long do I get the cash flow? How many years?
So it's a 7-year contract.
Okay.
So you own the ATMs, you get the deductions, the tax deductions from it, you get the cash flow from it, you get a consistent cash flow stream into the double digits for 84 months, 7 years.
Okay.
And it's paid and it's paid out monthly on the 25th of the month.
So what happens after 7 months? I mean 7 years, sorry.
Okay, so after 7 years, your contract is up and your cash flow stops and the deal is over. That portfolio then goes back out to the market and it's up for bid. So now, I mean, our company could be a bidder at that table. Most likely we would be, but it would go out to the open market for bid again, and we would have to buy that buy that portfolio again.
I see. So I still own those units or the ATM machines. They'll be up for bid.
You do. At the end of the 7-year period, as a service to you, our management team will take those machines and sell them at fair market value.
Okay.
But hey, it's a piece of technology.
Right.
You know what happens to your laptop in 7 years, right?
Oh, yeah, 3 years.
Yeah.
4 years.
So you're really not investing in ATMs for the equipment. You're investing in ATMs for the cash flow stream, the tax benefit. So, at the end of 7 years, your equipment's not worth a whole lot.
Got it. Awesome. Yeah, just wanted to make sure about that so that the listeners are aware as well. So, Dave, what are you up to nowadays? Is there any other deals have you been looking into?
There is. So I really don't think we'll be buying much in the we're not going to be investing much in the multifamily space. We are building a brand new Class A 240 unit multifamily apartment building down in Lake Charles, Louisiana.
Oh yes,
that will start this year. We like that market. There's just a few days ago, Driftwood, part of the Delorium company, got their kind of green light for their last hurdle that they were looking to get before they go into permitting to build out their $15 billion plant. Nice. And so there are a lot of projects like that's going on. That plant itself will export more LNG, natural gas, than the entire U.S.
really
exports right now. Wow. Yes. So you got a lot of that kind of stuff going on because the whole city of Lake Charles is turning from an import city to an export city. Huh? And so there's just a whole lot of activity going on there. So we got in front of that wave, and we're building residential assisted living down there, and we're building.
Yes, I heard about that. Yeah.
Yeah. And then so I don't believe we'll buy much existing multifamily like we have in the last number of years. I think that most of the low hanging fruit is gone in that space.
Oh yeah.
In fact, I think we'll be a seller in 2019. In fact, today I got two properties, two large multifamily deals that are supposed to be. I'm waiting for the email from my attorney. We're supposed to be closing today.
Oh, nice.
So
I
yeah,
think it's about time. It's pretty hard and a really competitive market in multifamily space because everyone is out there. And so that's about time when you need to get out of it.
we had a lot of fun in the last couple of years, and the market has given us some it's given us a nice gift in the last 5 or 6 years. I'll just say that. And so yeah, I think it's time for us to take some profits. I still love multifamily. We'll keep a core portfolio of probably maybe 1,500 doors. Right now, we've got around 3,000.
Oh, wow. Okay.
So we'll keep our core portfolio, but we are taking some money off the table right now. And then I imagine we'll be doing some self-storage. We got some self-storage in the pipeline. We're also working on a project down in South Texas where we're taking coal and breaking the coal down with high heat and extracting the liquids from the coal. And we've got contracts for the liquid, and that's also a very good cash flow play as well as a really good tax play.
Yeah, maybe I'll have to do another podcast with you on that.
Love to.
So that's
Love
awesome. So anything else we didn't cover about ATMs before we wrap up?
Oh, we covered the cash flow. Well, let's talk about the cash flow just a little bit. We've got, so your monthly cash on cash return is 24.5%. But the number that really matters is 15.4%. That's the number that takes the cash flow that you got. It subtracts the loss of value of your equipment over the 7-year period, and it factors in your tax benefits. So the real number that really matters is 15.4%. Now, if you had a 7-year play in an apartment building and you could get 15.4% IRR, I've seen better than that. I've seen worse than that. That's kind of, that's a decent real estate play. The difference is when you get your big bump in your IRR is when you sell the project at the end of 7 years. Here you're getting in ATM investing, you're getting your cash flow back so fast. If you're a high taxpayer, you're getting all of your principal back in 3 years, and now you got another 4 years of free cash flow. So you're really, when you consider the fact how fast you're getting your cash back or your principal back, now it becomes more like between a 17 and a 20% IRR.
Right.
So there's some similarities there, but you just got to know, you just got to be familiar before you get into the deal.
Right. And for me, it was the diversification as well. So it gave me, I of course was in real estate. As you know, I have invested in the coffee farm in Panama, like you.
Yeah.
Mahogany Bay Village Resort. So all over. So the idea was to diversify as much as possible.
Yeah, no, and we're actually teaming up with we're taking a bunch of guys down to a bunch of our investors. In fact, you should have got the email. Taking a bunch of our investors down to Mahogany Bay Village, and then we're jumping on an airplane and heading down to southern Belize, and we're going to do a little tour of the cacao farm.
I did that.
Chocolate, did you do that?
Yeah, I did in last January. It was a lot of fun.
Yeah, so we're taking about 20 of our investors down to see what's going on down in southern.
I got the email. I wanted to, but not now. It's crazy busy right now.
Yeah,
would love to hang out with you in Belize at some point.
we'll do it sometime.
Okay, thank you so much, Dale, for taking time out of your busy schedule. I appreciate it.
Thanks for having me on your show.